Hi, it's Dan Gilmore, Supply Chain Digest and the Supply Chain Television channel. Thanks so much for joining us on this video cast, which I'll just say is around the topic of supply chain risk management, but boy, we're going to cover a lot of ground. Certainly the topic of contingent business insurance and how that can help mitigate supply chain risks, as got from the original title of this broadcast, is one main topic, but we're going to talk a lot more about just supply chain risk mitigation generally and where the ROI is in risk mitigation tools and practices, including a modestly detailed look at some of those tools, including one that enables companies to fully map their extended supply chain using an almost LinkedIn type process that I have to say is very cool indeed. My first exposure to it. We've got a great panel today to discuss all these issues. Gary Lynch is one. He's the founder and CEO of the Risk Project. Bindia Vakel, who's the founder and CEO of Resiliency. Brian Jenkins is supply chain risk finance manager, for GM, and Vonnie French finally, who heads the supply chain operations for Palo Alto Networks, a high-tech company. We got people coming to us from all over the country here today: Detroit, Silicon Valley, New York, New Jersey area. I'm here in Ohio, so we're really ranging around. Actually, it's going to be a little bit easy for me today. That I'm just doing some intros and closing up, and actually Gary Lynch, who I just mentioned, will be doing most of the moderating with our all-star panel here. So mostly I'm just going to introduce each guest and sit back and enjoy the show. I've seen the materials. I can promise you this is going to be a very interesting broadcast. I know I'm going to learn something. I promise you will too. Before we get going with all that, the usual type of housekeeping rules. I think this broadcast is going to last somewhere in the 40 to 45 minute range. Just my assessment is going to be somewhere around that, after which we'll go to a live Q&A. You're going to see on your screen a kind of a chat type window. Anytime during the course of the broadcast, you can type in a question, hit submit, we'll gather it up, and at the end of the broadcast, do a live Q&A lasting 10 or 12 minutes or so. That chat window, you may see it now, you may have to scroll down, depends on your resolution, your monitor, those kind of things, but I know you'll be able to find it. Within 24 to 48 hours, you'll get an email from Supply Chain Digest if you're registered for this broadcast. It'll have a link to the on-demand version of the broadcast with the Q&A. It's going to have a podcast of the Q&A session, which a lot of people are taking advantage of. It's going to have a copy of today's modest slide materials, but you may want to join that. It's going to have some links to other resources, etc. I know you want to take advantage of all of that. So before we get going with that, I'm just going to turn the broadcast over to Gary Lynch. Gary is the founder and CEO of the Risk Project, a global risk advisory and research firm. Before that, he was the global leader of Marsh's Risk Management Consulting, Risk Intelligence Strategies, and Resiliency Solutions practice from 2004 to 2013. That's a big-time player in this business. Under his direction, Marsh earned a distinction as the world's best supply chain risk consulting provider by Global Finance magazine and top 25 information manager by Information Management magazine. Gary was appointed to the U.S. Department of Commerce's Advisory Committee on Supply Chain Competitiveness in 2012, and he works with 35 other members on that panel to advise the Secretary of Commerce and the President. Gary is currently working on his third book, due out sometime in the third quarter, titled Uncertainty Advantage: Critical Lessons from Navigating Risk and Performance to Gain Market Edge. So you can say he knows what he's talking about. His first guest is actually going to be Bindia Vakel, who is the founder and CEO of Resiliency and a recognized thought leader in the area of supply chain risk management. Let me tell you, I've gotten a chance to work with her a little bit here, and she also very much knows her stuff. You're going to learn a lot from Bindia. She's been a practitioner in the high-tech supply chain management before starting Resiliency with companies including Flextronics, Cisco, and Broadcom. So these are two world-class experts. Let me tell you, I know I'm going to learn, again, I promise you will too. So I'm now going to turn the podium over to Gary to kick off the broadcast.
Thank you, Dan. Today we'll focus on another tool in the risk management portfolio of mitigation and financing solutions. Insurance, unlike inventory diversification or holding safety stock, is a risk transfer mechanism designed to get others to underwrite and assume some of the risk, of course, for a price. Insurance comes in all shapes and sizes. There's first-party insurance, such as property insurance, but there's also third-party contingent business interruption insurance, supply chain insurance, trade disruption insurance, and stock throughput insurance. And typically the purpose of insurance is to stabilize earnings or smooth volatility. If you're going to get others to take on some risk, they of course will have an expectation, and we're going to hear about those expectations today from three experts and three different vantage points, three different industries. We'll hear about the methods and tools they're going to use to sustain a risk transfer vehicle such as contingent business interruption. One important note, though, is the contingent business interruption market has changed dramatically since the events of 2011 in Japan and Thailand. So it's important to understand that these changes have really driven need for understanding aggregate exposure when you're relying on the same third parties as your competitor. And of course, the other part of it is that those third parties now have to be named, they can't be unnamed. So to better understand these issues, we're going to focus on a few key questions. They are: when to consider insurance, what do you need to know to qualify to get the best price or the optimal coverage, and how tools and methods can help securing contingent business interruption insurance at the most optimal cost. So let me start off with Bindia. Bindia, can you explain a little bit about Resiliency, what it does, and really how it helps organizations secure insurance and use it as a vehicle for managing risk?
Yeah, thank you. So Reslink is essentially a company we call, what Gartner calls us is the LinkedIn for supply chain. If you think about the LinkedIn model, which is, I go on LinkedIn, I can put in my information about my profile and do it once and then share it many times with my network. In the same way, Reslink connects many customers with many suppliers, but it does so in a way that suppliers can put in tremendous amounts of information about their global supply chain dependencies, their operations, their global locations, their second and third tier suppliers, but without creating a tremendous amount of data entry, replication of effort for the supplier. So a la LinkedIn, supplier can do the work, do it once, and then share the information with many customers. So what that enables our customers and suppliers to do, and how that becomes relevant for insurance, is that for the contingent business interruption process, you really have the information as the foundational piece, which is mapping of the global supply chain and getting visibility to the suppliers, global factories, as well as their suppliers and their global factories. So having that multi-tier visibility becomes a critical portion of a robust supply chain resiliency program. And now if you think about how Resilink plays in that space, is because our suppliers have already done this work on our platform, they're able to share with many customers. We have a tremendous amount of supply chain network already built out for industries like high tech, life science, med devices, automotive, etc. For the high-tech supply chain, for example, we have mapped about 85–90% of that high-tech supply chain with onboarding over 20,000 suppliers worldwide. So there's a tremendous amount of intelligence that has already been created that the next customer who comes on board can tap into and get value very, very quickly. So but it is very important to get this information, not just at the supplier level, but understand it down to part number level, because it's very important to know, because this product, which is my top revenue impact product, is using a bunch of sites in Taiwan. Those sites in Taiwan have a very high impact to business if something were to happen in Taiwan. So having that information gathered, mapped back to the bill of material and mapped back to the top line revenue and profitability of the company seamlessly on one platform becomes a really critical capability. And therefore, having this information at a part level is very critical. Having this information in a centralized repository with analytics built on top are also a very important way for us to be able to quantify the level of exposure and vulnerability that are important elements of the insurance buying process. So in our system, in the Reslink system, every part, every supplier, and every location in the world has a number tied to it, which reflects two things. One is the impact of losing that supplier site or part expressed in terms of revenue. So if I lose this part, what is the impact in terms of revenue to my business? Or if I lose this location, what is the revenue impact? And we do this for every supplier, every site, and every part that the customer loads in the system. And the second is, what is the inherent vulnerability? Is this supplier located in a natural disaster area? Is the recovery time associated with this site very long? How robust is the supplier's business continuity capability? what is the capacity at the site that's available? All of these types of intelligence become foundational in being able to set the insurance company's mind to rest about the fundamental capability and risk profile of the company that they're trying to insure. In addition to all of the information and the analytics that Resiliency provides, the other piece is what we like to call the weather.com type of service. So what we do is on a 24/7 basis, Resiliency monitors the supply chain for about 30 different types of disruptions. Now, obviously, people want to know about catastrophic things, but a lot of times we see that there are factory fires happening almost on a daily basis around the world, and a second tier or third tier supplier factory fire might actually have a huge impact over the coming weeks on your supply chain. So we monitor anything from factory fires, port strikes, labor strikes, transportation strikes, power outages, chemical spills, catastrophic events, and even, EPA or OSHA type of organization shutting down a factory that is not compliant with rules and regulations. So all of this together form a complete capability from a proactive standpoint, understanding the supply chain, understanding the vulnerabilities, the dependencies worldwide, and then quantifying how big of an impact these vulnerabilities could have on the company, pinpointing the specific type of vulnerability, whether it's a financial problem, whether it's a location problem, whether it's a recovery issue, whether it's a sub-tier dependency, etc. And then having a workflow-based mechanism for managing mitigation activity and tracking mitigation as the users perform it over time, but then simultaneously having this continuous 24/7 event monitoring service that then ties seamlessly back to the map data, so that when something happens halfway around the world that gets reported in a Thai newspaper or in a Chinese newspaper, being able to have that information seamlessly at your fingertips so that you can create that virtual war room, if you will, invite the 10 people or 20 people who are going to be part of the mitigation and response process to react and recover from this disruption. We have the full suite on Resiliency.
Thank you, Vindhya. Could you, it obviously sounds like an enormous challenge for any size organization. Could you, in maybe 5 or 6 points, just highlighted points, could you explain the supply chain risk management process and really what organizations should focus on?
Yeah, so like I said, when you think about from a supply chain risk management standpoint, a lot of companies forget that the basic foundation is information. This is one of the reasons why Resiliency started with collecting information from the suppliers, but also making it easy for the suppliers to provide this information. Information is mapping of the supply chain, understanding, like I said, where are the factories located? Does the supplier have sufficient alternate sites available in order to react and respond and recover the business? What are the inherent vulnerabilities associated with those locations? What is the business continuity capability that the supplier has? Who are the tier 2 suppliers they do business with? What are the type of commodities that they buy? So having this information becomes foundational from a process standpoint. On top of that is the quantification capability, understanding the biggest exposures and vulnerabilities, and then having a internal governance process for determining, prioritizing what are the highest risks that we're going to focus on and mitigate. What are the risks that we can accept because they're falling within our risk tolerances or thresholds? What are the risks that we're going to not be able to mitigate? We're going to have to manage that when bad things happen. And then finally, what is a risk that we absolutely need to do something about, but it might be too expensive to mitigate? Oh, maybe we might want to buy contingent business interruption insurance for these. So if you think about that framework for a program, it's really setting the tolerances and acceptance thresholds. It is what can we mitigate proactively, and it is cost effective to mitigate proactively. What is maybe not as cost effective to mitigate, but that there's not as frequent of a disruption potential. Therefore, let's have a robust crisis response recovery process to help us be on top of the situation, have our finger on the pulse, and manage effectively when it happens by virtue of our responsive crisis management process. And then finally, at the top, cannot accept this risk, cannot proactively mitigate, cannot just depend on crisis response, need to protect our profitability, therefore look at insurance. It all comes together by virtue of a proper governance process, and the process really has to be institutionalized within the company. It is not something supply chain can do by themselves, and it is not something that falls entirely within the purview of an enterprise risk management or treasury department. This is definitely one of those areas where ERM and treasury, coming out of the corporate finance organization, really collaboratively works together with the supply chain risk management team and forms an ongoing cadence of collaboration, meetings, metrics, targets, and goals in order to manage resiliency in a holistic and continuous way.
So before we dive into contingent business interruption, insurance is just one of the strategies to proactively manage risk. There's a variety of other options that you touched upon and that would be appropriate for companies playing multiple strategies. Could you outline some of those, Bindya?
Yeah, so in terms of mitigation strategies, obviously there are multiple ways in which companies approach risk mitigation. A lot of times people default to second sourcing and inventory, but it's important to think about risk holistically and understand that it may not always be possible to hold more inventory or second source. Therefore, it's important to keep an eye on other approaches and other things that having the right information at hand can drive other better, more longer term mitigation approaches. So obviously inventory, safety stock management, we talked about that, but also forward buying and hedging to mitigate risks of costs going up. For example, if you had information about industry movements and pricing, etc., forward buying can definitely help. Close collaboration and planning with top tier suppliers a lot of times is not something that companies do across the right sets of commodities. So identifying what suppliers are strategic and long-term partners, and then collaborating, having longer-term outlook types of discussions with them can get a tremendous amount of market intelligence and help manage risk effectively. It's very important simultaneously to conduct active supplier monitoring. A lot of times we see companies are very dependent on their suppliers to tell them when things happen, but the reality is that suppliers will assess their own impact before they start actively notifying customers. Therefore, being in control of supplier monitoring is actually very critical. The other thing is this whole mapping effort drives a tremendous amount of information and supplier intelligence into your organization, and you now would have, with that intelligence, you would be able to tell, does the supplier have alternate sites? Have they put redundant manufacturing in place for the critical parts you care about? These types of supplier implemented mitigations can actually go a long way towards protecting your own supply chain and business with that supplier. The other is contract management. Using your contract to enable risk sharing and performance-based metrics and variables is really important as well to protect supply lines. For example, force majeure, if you look at just the force majeure clause, it gives the supplier a big out. But a lot of companies now say, well, if the force majeure type event happens, you will revert to your business continuity plan, which is a documented plan if you have collected that type of information. And then that leads then to standards for business continuity capability. What are the minimum requirements that a supplier's BCP needs to have, because now the BCP is a contractually enforceable document. And then finally, proactively, a lot of companies know this, but haven't put this in place, but product design is the point at which you are designing in future problems, because you're making supplier selection, part selection, manufacturing site selection decisions. So this is your best opportunity to put mitigations, redundancies, and product design elements in place that help you design in another source or be compatible with another supplier in future. So for your critical products, implementing a proper design for resiliency program, making sure supply chain has a seat at the table during the product design process is a very, very effective and very cost-effective mitigation approach as well. Gary?
Thank you, Bindya. Bindya, I'm going to just touch on one of your favorite concepts, or one of the terms you talk about a lot, which is return on investment. How would you position a contingent business interruption or an insurance return on investment within the broader return on investment model for supply chain risk management investments?
On the return side of supply chain risk management program investment, obviously we need to monetize the potential financial benefits based on a lot of different factors. Insurance benefits are very important, and they're often overlooked, but there are actually quite a lot of other benefits that you may want to quantify. So at a high level, if I were to put them in three major categories, I would say incremental revenue would be one, operational cost savings would be the second category, and productivity savings would be the third. If you look at incremental revenue, then it's really the expected value of the proactive risk mitigations that you have in place, right? So because you have a protected supply chain proactively, you are expected to, perform better on your ongoing on-time delivery and other ongoing operational metrics from a top-line standpoint. The second is, in the case of a crisis, because you have a well thought out supply chain risk management program, you're not likely to suffer large scale losses, and there's an expected revenue value of your protected supply chain event response. So those are the two on the top line standpoint from a revenue standpoint. On the operational side, CBI insurance premiums and improved coverage and having a robust program can really help you expand the coverage and expand the benefits, like we're hearing today from Brian and Bonnie and Gary. But also, if you had to buy raw materials at a premium, then you might experience raw material sourcing premiums and freight expedite costs that were unexpected, which result in profit leakages. There's also, like I was saying, advanced sourcing. So for example, if you think about your suppliers and their suppliers and their suppliers' suppliers, and the knowledge and the intelligence of knowing what those constrained raw materials are across your supply chain, and having some type of a forward buying or advanced sourcing type of or preferential pricing arrangement can really help you control the availability and bottlenecks within that sub-tier supply chain. Very, very strategic. There are actually some really phenomenal examples in high tech of companies like Apple doing those types of things, also from a competitive advantage standpoint, keeping competition out. The other is, if you have a massive impact, you end up having a lot of other contingent and labor costs that you would avoid. Inventory holding cost is actually very interesting, and it's counterintuitive sometimes to think that having a supply chain resiliency program would actually result in savings on the inventory holding cost side, but that's something that we experience as well. And then finally, having a robust visibility program, lots of intelligence, stronger supplier partnerships result in a reduced recall and settlement payments. The final category is really the productivity savings. So these are really the incremental costs that are associated with people working risk management programs in a very manual way. So when you have a solution that can automate some of that, what we have seen is companies who have 8, 9 people in their risk management organization can really go down to 1 to 2 people because of having an automated solution. This is a huge area of cost savings, but also improves the accuracy of the information and the repeatability and the scalability of the tasks performed around information, supplier information, data collection, management, supply chain mapping. Searching for information, a lot of times we find that within the supply chain, people are very dependent on commodity managers to respond to their request for, hey, I have this problem, I need this information about the supplier. Having all this information about suppliers sitting in a central repository can result in people leveraging information without waiting for days or weeks for a commodity manager to pay attention to their request. And finally, the commodity manager's job is cost savings and supplier development and supplier relationship management, and having to continuously support internal teams in giving supplier information results in them not being able to focus on these tasks. And so there's a opportunity cost today of not having a system, which is that commodity managers can't achieve their cost saving targets or aren't achieving the full potential of cost savings that they could simply because they're not focused on that activity. So on the investment side then of the ROI, what you're looking at the cost of having a program, which is in terms of a program management headcount, maybe there might be some IT related costs, and then there's the cost of a system, putting a system in place.
India, thank you for that comprehensive response, and also a good start to our webcast here, our video cast. At this time, I'd like to turn it back over to Dan.
Okay, some very interesting stuff there again. A lot of stuff that I learned here, and this notion of really being able to map your supply chain in a LinkedIn type fashion. We're going to dig into this more in Supply Chain Digest in future weeks, but pretty cool stuff there and very articulate discussion. Okay, our first practitioner guest is going to be Brian Jenkins. He is the Risk Finance Manager for GM, and he's coming to us from, as you'd expect, the Detroit area. In his role, Brian has global responsibility for GM's insurance covering losses from damage to property and resultant business interruption, including BI, business interruption losses emanating from the supply chain, of course. Prior to joining GM in 2011, Brian was Director of Insurance and Risk Management at another Fortune 200 auto supplier, managed dealer distributed insurance products for GMAC in Europe and Latin America, and was Regional Risk Manager for GM Europe. So again, he's pretty knee-deep in this stuff. He's going to talk over what GM is doing with Gary Lynch.
Thanks again, Dan. Well, let me take a crack at what the underwriters, insurers, brokers are all looking for. And 3 items come to mind. First of all, the ability to establish values. What's the value of the relationship with the third party and the potential loss of revenue if there was a failure? To rely on accepted or proven methods to calculate values is going to be critical for the organization. The second item that comes to mind is confidence. Really confidence. The underwriters want to ensure that the organization has an effective risk management program. They understand what the risks are and how they're being managed, the interdependencies, the interoperability amongst the organization as far as the upstream is concerned, and how it connects to value, such as the inventory. And then the last piece is really a sustainable and manageable solution, not just a one-shot effort. So what I'd like to do now is take a look at this from 2 vantage points here. 2 very different companies. One is General Motors, as you know, is a global organization, been around for a very long time. We're going to get a treasury risk management perspective. And the other organization is a smaller but rapidly growing Silicon Valley technology startup. So we'll get an operations perspective and a risk management perspective through the Treasury Group. So Brian, let me start with you. What, in your opinion, is the value of contingent business interruption insurance, and what are some of the do's and don'ts to help manage risk?
Well, different organizations take different approaches to insurance, so some are going to value things differently. We really only want to buy insurance for catastrophic events. We focus most of our efforts on risk control, either avoid losses or mitigate them to the extent that we can through our risk management efforts. Insurance doesn't do much to help us with that. That said, underwriters' questions can help your organization focus on certain issues or areas of risk. But compiling an underwriting submission, buy insurance, and perfecting insurance claims are activities that take a lot of time. So that really just reinforces our approach of just buying the insurance for low frequency, high severity events. But we also realize we can't predict and model everything, so we look at insurance as a sort of last resort, a source of capital when something truly catastrophic happens.
Right, and it seems to be, there seems to be a lot of different types of coverage out there. What type of coverage applies and what kind of data is really needed to buy the coverage?
Insurance companies offer contingent business interruption or CBI insurance. It's also called contingent time element insurance. And that covers things like extra expense, continuing expense, and lost profit following an ordinarily insured event resulting in physical damage that prevents a supplier from supplying goods or services. That sounded like a bunch of insurance speak. It is. What it means is the insurance can cover you for losses from catastrophic events that happen within your supply chain. The coverage is usually made available as part of your normal property and business interruption insurance as a coverage extension. And coverage that insurers are willing to offer to a given company or a given risk will likely vary depending on the industry they're in, their risk profile, and that company's actual or perceived approach to risk management. An insurance broker would definitely be able to help anybody understand what the insurable risks are and the coverage that may be available to a given company or industry from the insurance marketplace. To buy the coverage, you're going to need to help underwriters understand your supply chain, how you manage supply chain risks, and potentially even provide a listing of the location of specific suppliers. Insurers may also want to know what you see as your worst case scenarios and what you're doing or can do about them.
So it appears like measuring impact is critical. How does an organization go about measuring impact, and what is it that the insurers are looking for with regard to impact?
Well, they're looking at the magnitude of potentially insured loss. In other words, how much they might have to pay you for extra expense, continuing expense, and lost profit if something happened. Actually, one of the big challenges with CBI insurance is how can you measure with a reasonable degree of accuracy what impact a given event may cause? Now, the supply chain can be so complicated. There are so many variables that come into play after an interruption, like recovery time or dual tooling or alternative suppliers. It's really hard to know what the impact will be. Insurance companies understandably want to model risk, the risk they take on. They want to quantify what they might be faced with, especially if a single event affects a lot of their clients. But the complexity and fluidity of the supply chain makes that really difficult to do. So when you're trying to measure the potential cost of an interruption, it's very scenario specific, and I think you have to be careful that you don't end up overstating the exposure.
Sounds like a very complex challenge and a lot of moving parts. How does technology such as Resiliency solution help in providing the ability to manage all that complexity and all those individual elements?
Well, part of the value is just demonstrating that you take the risk seriously enough that you're willing to go to great lengths to understand and control. Supply chain risk is obviously a real challenge. It's important to help insurers understand what you're doing to minimize your and their exposure. So being able to demonstrate commitment is a starting point. But beyond that, anything that helps you gain visibility into the supply chain is going to help you respond more quickly and effectively to potential interruption and reduce the impact. Again, it's important to help insurers understand how greater visibility helps. In other words, to be able to show some real examples, like after such and such event occurred, we were able to quickly see that these certain suppliers might be affected, and immediately start taking steps to mitigate the impact. The Japan earthquake in 2011 really showed the value of being able to quickly understand the potential impact to your organization.
It sounds like over the years, GM has tremendous experience, and you have tremendous experience in this area. Are there some do's and don'ts you can share, or some lessons you can share with our listening audience?
Sure. The main thing for me is how important it is to collaborate to have collaboration between insurance buying activity and the supply chain organization within a company. Our groups in our company have worked really closely together, and it's made a huge difference. We've shared some of the analyses that we do to support our insurance buying activity with our supply chain group. And then through our group, our supply chain team has talked directly to our insurers. So the insurers are hearing directly from the experts, and that means a lot to underwriters. Again, after Japan in 2011, the market for CBI insurance became really difficult. Insurers maybe hadn't thought about the risk enough before Japan, and there was this massive pressure to catch up. So being able to share our approach and conclusions has been really helpful in the insurance buying process. And the difficulty modeling the risk makes it even more important to be able to demonstrate our risk management capability.
It seems like we're all measured on outcomes. Could you provide any example of some outcomes?
Well, what I can say is there's no doubt in my mind that sharing with insurance companies the approach and progress of our supply chain group through our partnership with Resiliency and in other areas, it's improved our insurance coverage. Without getting into specifics, we've received universally positive feedback from our insurance partners.
Well, I'd like to thank you, Brian, for your comments, very helpful comments here. And at this point, I'd like to turn it back to Dan.
Okay, some more great stuff. But now from a slightly different perspective, that was kind of the risk, risk side of things, the finance side of things within GM with Brian here. Now we're going to have Vonnie French, who's joining us from the Silicon Valley area. Vonnie is responsible for Palo Alto Network's supply chain operations, and she's been there since February 2007. But she brings over 25 years of supply chain operations experience with both established and high-growth startup companies. She's responsible for the design and implementation of the company's end-to-end supply chain and fulfillment strategies, including supply chain planning, manufacturing, order fulfillment, trade, global logistics, supply chain resiliency and security. She has it all. She's led the implementation of truly world-class supply chain risk and resiliency models that is among the best there is for a company of Palo Alto Network size, or even when compared to significantly larger companies. So again, gotten a chance to discuss some of this with Vonnie prior to the broadcast here. She really knows what she's doing and how this risk and contingent business insurance intersects with supply chain operations. Very interesting story. So Gary, once again, back to you.
Okay, well, thanks again, Dan. And let me bring in Vonnie French of Palo Alto Networks. She's going to join us from Silicon Valley. Welcome, Vonnie.
And hey, thanks, Gary. Good to be here.
It's good to see you again, and it's going to be great to get that operations and management perspective now. We've heard a lot about the insurance side of it. Now we're going to transition into the operations and management side of supply chain risk management. So can you give us a little background, start us off with your supply chain risk management program and what it looks like at Palo Alto?
Yeah, sure. We were initially introduced to Resiliency and the supply chain risk management program through our manufacturing partner around the same time that the earthquake and tsunami hit Japan in March of 2011. And the ability to quickly assess our supply chain and determine any business impact was extremely critical, as I'm sure you know. Supply chain risk and business continuity are important, obviously, to all companies, but it was really important to us in 2012 prior to our IPO. And the decision to engage directly with a partner like Resiliency to help in our effort to ensure business continuity and in developing a resilient supply chain became a strategic imperative for us.
Vonnie, can you give us a description? I think, from our prior conversation, our audience is aware that there is an annual process for renewing the insurance and reevaluating the program. Can you give us some sense of what the annual insurance process looks like at Palo Alto Networks?
Yeah, sure. I got brought into the annual process right after we went public in 2012, so it was kind of new to me. But the supply chain operations management plays a key role in the contingent business insurance process every year. A well thought out supply chain with deep visibility into potential disruptions makes insurance carriers involved much more comfortable with the risk. Understanding the various steps taken to minimize potential catastrophic loss, that would result in insurance company payouts provides comfort to carriers offering higher limits than what might normally be offered to a less desirable risk. And so all insurance carriers worry about aggregation of exposures at contract manufacturing facilities, and the depth of data that we're able to provide regarding options, quantification of exposure, the strong relationship that we have with our contract manufacturer, and the supply chain risk management program that we have in place really makes us stand out amongst other companies who may be vying for the insurance company's attention and capacity. And so really the benefit of the program that we have put in place is that it has allowed our insurance broker to help the insurer better quantify the true exposures we face, and by extension gives the carrier greater comfort in providing adequate limits at a competitive premium.
Well, it sounds like you have to bring together the cooperation of multiple parties, and it also sounds like there is specific data that you need to collect and probably data you don't need to collect. Can you talk about some of the data you need to collect? Where do you begin with your stakeholders? Who are these stakeholders?
Yeah, sure. Kind of the overall holistic view at the supply chain level, the focus on continuity of supply really encompasses the visibility into our supply chain beyond the first and second tiers of suppliers, which would be both manufacturers and directly controlled suppliers. And so it's vital to collect the manufacturing location information about that specific location, be it geographical, government influence, ability and timeline for the location, etc. The other items that we consider is the financial stability of suppliers within our supply chain and the dependencies on their own supply chain. All of this information assists us to manage and proactively mitigate risks that could impact the top line of our business. And the key stakeholders in all of these initiatives are made up from various functions within the operations organization, which includes the supply chain resiliency team, the supply-based management team, and even our manufacturing engineering. Hardware engineering and the designers here at Palo Alto Networks are also a part of the core team for product development.
So when you bring this team together and you're looking to quantify the impact or the exposure, what are those elements that go into quantification of exposure, that collective process you have in place?
Yeah, so from a risk perspective, we quantify exposure with the potential lost billings across or along with the cost recovery. For example, prepaid inventory, freight costs, etc.
And your organization has an expectation with regard to insurance as a risk transfer vehicle or a risk financing vehicle, specifically, this contingent business interruption insurance we've talked about. Can you describe briefly what the expectation is of your organization? What do they expect out of an insurance program like this?
Yeah, I think the amount of investment that the business will make to mitigate risk is based on its exposure threshold. So how much exposure really is acceptable. Insurance is in place to close the gap for potential loss of revenue outside of the mitigated exposures.
And so a third-party tool like the Resiliency tool, how does that provide value as a solution?
Yeah, so Resiliency and other similar tools that we use are an outsourced service that identifies the supply chain risks down to the part number or manufacturing site. The data collected is the basis for mitigation, planning, and execution. And the information is also used for disaster recovery planning and business impact analysis. It provides proactive notification of risk issues to resolve before they even impact the business.
So what are some of the benefits then from the program? What does management see as an output of this program, and what do you think are some of the critical benefits?
I think proactively assessing product risk during development, which is what we've adopted here at Palo Alto Networks, has significantly reduced the number of parts that could impact products prior to release, or even potentially production line down situations once it's in sustaining.
Okay, Vonnie, just one more question. You must have a wish list. If you had one item to add to that wish list or to your to-do list, what would it be?
Yeah, I think, in the supply chain business, we have a lot of wishes. But when I look just at the resiliency program that we have in place today to mitigate risks, on my wish list right now is really kind of a deeper dive in collection of data beyond the tier 1 or tier 2 suppliers. That's going to help us identify risk further down the supply chain.
Thank you, Vonnie, for that tremendous insight. And now I'd like to hand it back to Brian.
Yeah, you're welcome, Gary. Great to see you.
Okay, and we're going to wrap it up here. Back to Gary with one more very short conversation with Bindia of Resiliency, who's just going to share some information about where you can get additional resources and information to help you start down this journey of better understanding approaches to supply chain risk management. Gary, one more time, back to you.
Okay, thanks, Dan. Bindia, where can people go to get started on supply chain risk management? What kind of resources are out there, and how can you help them in getting started?
Yeah, so thanks for asking that question. So there are a few that you can go to and get access to immediately. For example, if you go on LinkedIn and search for the Global Supply Chain Resiliency Council, this is a group of about 800 people worldwide. You can participate in online discussions, ask them questions, network with them. That's definitely a resource that you have to network with people who have been there, done that, and access historical discussions, etc. There's also the Ultimate Guide to Supply Chain Resiliency Program Success, which is available off of our website. Our website also has, so if you go to resilink.com and you go to the resources section, we have a lot of recorded webcasts and white papers that you can access on ROI and how to go about developing business case, convincing your executive management, and computing the ROI. And then finally, there's a really good PwC MIT paper that is also providing some high-level benchmark information of mature companies who have a robust resiliency program, how they perform on operational metrics, and what is the ROI of that capability.
Thank you, Bindia. And I'd like to also thank the panelists, Vonnie and Brian. And at this point, I'd like to turn it over to Dan for closing remarks.
Okay, wow, well that was a lot of stuff. Thanks to Gary Lynch and from the Risk Project and all of the other guests that we had, Brian, Vonnie, Bindia, et cetera, that really did a fantastic job. I learned a lot, connecting this insurance side of things with some exciting new tools and potential there, from everything from the mapping type of tools to the risk monitoring type services here. There's a lot that can be done, obviously, here, and a lot of leading companies such as GM and Palo Alto Networks are doing it. Obviously, there may be some opportunities for you. We're now going to march to the live Q&A. You're going to see here on your screen a list of resources, how to get a hold of any of our panelists, as well as some websites and other resource pages you might want to take advantage of. A lot of these will be repeated in the email you get from us for the on-demand version of this broadcast. We certainly encourage you to follow up with any questions you may have, or to get some additional information here. So with that, we're now going to go to that live Q&A. You're going to see here on your screen a link. Just click on that link. That's going to start a live audio stream. We'll spend the next 10 to 12 minutes answering as many of your questions as we can. I want to thank you for joining us on this broadcast from Supply Chain Digest and the Supply Chain Television channel. We look forward to seeing you on another video cast very soon. Thanks so much, everybody.
So, okay, this is Dan Gilmore, Supply Chain Digest and the Supply Chain Television channel. Very pleased you joined us for this very interesting broadcast from people from all over the country, talking about supply chain risk management, contingent business interruption insurance, and supply chain ROI when it comes to risk management, and a whole lot more. So I believe we had a couple drop off, but I think we came back. All of our panelists on today. That's who's Bindia Veckel from Resiliency, Gary Lynch of the Risk Project, Brian Jenkins from GM, Vonnie French from Palo Alto Networks. Quite a panel we had here indeed today. Everyone, thanks so much for joining me today.
Pleasure
Thank
to be
you.
here. Thank you.
Okay, so we did get a good handful of questions in. You can still answer your ask a question on either of the screens you may be on there. You see that little chat type window. You just type in your question, hit submit, and we'll pick up as many of them as we can. We went about 50 minutes here today, so probably just spend the next 10, 12 minutes, get to the top of the hour with questions, and we'll try to get through as many of them as we can. Mindy, I'm going to start with you. I like to start off kind of just some questions for me, and I love this concept of, sort of like the LinkedIn for supply chain risk management. Just maybe, explain that, a little bit more. I mean, you've got a database, I'm assuming, of all these suppliers. I forget the number I think you threw out there during the course of the broadcast, and people can, in effect, sort of subscribe or add those sourcing locations to their supply chain map. How does it work?
Yeah, thank you. Yeah, so the LinkedIn for supply chain concept, just by way of background, is it's risk management, and all aspects of risk management start with information. The more intelligence you have about your supply chain dependencies, whether it's in terms of global locations or second-tier, third-tier suppliers and their locations, the more you have the ability to control things that could go wrong, predict and anticipate where the weaknesses or exposure points of vulnerabilities are. So collecting the data for this level of intelligence, however, is a pretty big task. So what we at Resiliency like to say is it's like mapping the supply chain genome, if you will, where we've undertaken the task of understanding more than 20,000 suppliers and mapping out their global locations, understanding where parts are manufactured around the world, what alternate sites do they have, et cetera, and then who are their second-tier suppliers, third-tier suppliers, what types of commodities and parts are being purchased from those tiers. The reason for the LinkedIn model is that we want to make this data collection process seamless and cost-effective for customers and low resource intensive for suppliers. So just like you go on LinkedIn, you put in a lot of your information and you check the box and approve multiple people to have access to your information. Similarly, what Resiliency enables is suppliers can come into our platform, put in information about their global dependencies and supplier names and sites and part numbers made at different sites, et cetera. But then as customers approach them, they can simply check the box and that customer will now see information pertaining to their supply chain without the supplier having to repeat data entry multiple times.
Well, that's just very, very cool, and certainly I've got some exposure to companies. I wrote an article a couple of years ago about the imperative to map your supply chain, and I cited the example of Honda, who got some grant from the National Sciences Foundation here in the U.S., and it took them like 2 years to map the supply chain for just what they call the center console or something. So it's a huge, huge project if you're a big company, and obviously this sounds like a way to very much accelerate that process at a lot less time and cost. So very, very cool. So as we kind of get going,
Dan, so just to on that exact point, what my observation when I was in industry was that I felt that it was within the purview of the companies with deep pockets to go undertake this exercise, because it was multiple years and it wasn't something that could be done, in a cost-effective way. So that what Resiliency enables companies to do is, whether you're a $100 million company or whether you're a $10, $20, $50 billion company, you now have access to all of this information. But the beauty of this is that when the supplier is ready to not only put the data in, but update and refresh it, it isn't another 2-year exercise. The refresh process becomes a lot more cost effective because over time, more customers are accessing this information and asking suppliers to get the refresh done.
Very good. Yes, excellent. Okay, fantastic. So I'm going to try to spread it around here a little bit and give everyone a question here as we get into this Q&A. Gary, I'm going to start with you. Great job moderating this video discussion. I will note. But and I'm not a contingent business interruption insurance expert by any means. I certainly learned a lot during the course of this broadcast. What are some of the limitations of CBI? Are there other products or alternatives out there when you kind of reach the end of what you can achieve with the CBI type product?
Well, thanks, Dan, and thanks for the question. At the end of the day, the CBI, contingent business interruption, just like property insurance, is just one of those vehicles that can be used to transfer
and disseminate the risk amongst multiple parties. But there are other products out there, and it's been, kind of a developing area, an early developing area. So, for example, the limitations of CBI are the events that occur that you can potentially use contingent business interruption insurance on for your third-party suppliers are mostly physical events, fires, floods, rising water, winds, those kinds of things that affect your third parties. But what's happened is a number of years ago, let's see now, it's about probably 4 or 5 years ago, we got together in the industry and said, what about those non-physical events? What about, at the time, pandemics, bird flu, port strikes, nationalization, some of the other events that could interrupt your supply chain, especially from the upstream side, from the supplier side, cause a disruption, and how do we get some protection there and assure some continuity? And so the supply chain insurance was developed, and granted, it was developed with some limits of up to about $100 million or so in exposure coverage, which for the big companies is not a lot. For little companies, it's too much. And initially, it was expensive, but that's become much more reasonable now. Other vehicles include trade disruption insurance for those that are in the business of taking on a product, let's say in the retail space, taking on product, owning it, and then potentially entering into a contract where they can return it if they don't sell it. Trade disruption insurance may or may not apply there, but it's really in the movement and the transportation of the goods as well. Again, some limit issues. There's also another vehicle called captives. And that's basically where you set up a separate entity, usually as part of your, it would be adjunct to your organization, or it could be an industry group that comes together and says, we're going to underwrite the risk ourselves. So there's a lot of vehicles, and the brokers have been very active in this space, and so they're trying to get creative in providing a comprehensive solution as opposed to just a solution that applies to one set of problems, which would be, physical events, and broaden it to any event. And that's basically where the carriers have gone as well, the underwriters.
Okay, very good. Well, excellent. Well, that's actually going to kind of segue into a couple things for me. I'm going to have a two-part question here to Vani and then to Brian. So, Vani, I'm going to start with you here. We just heard quite a bit there where we know about the different alternatives out there for insurance and whatnot. And, of course, you're in supply chain operations, and, the head of supply chain is often charged with leading the charge for risk mitigation strategies and whatnot. I'm not sure how many of them are experts in insurance, however, and I just wondered your kind of thoughts there. What the supply chain executives, how much do they need to know, and do you see that evolving?
Yeah, well, thanks for the question. I'm by all means no expert in insurance. However, when we started this program over four years ago now, and I started meeting with the Treasury team here internally, and they were putting me in front of some of the brokers that we had. What we found was there's nobody that knows supply chain better than the supply chain experts. And a lot of the questions that are usually posed to the Treasury team around business continuity plans, resiliency within the supply chain, they couldn't answer. And so what we found is the more time that we actually spent with the insurance brokers, the better off we were. They basically said, look, we appreciate that you and your team take the time to develop these deep relationships with suppliers. It's crucial to the cost and the availability of CBI insurance. And the more that we were able to share with them and get them comfortable with the program that we had in place, the better off that we were as a company when our insurance premiums were delivered to us. And what we found through the process is by providing them with the comfort to the carriers, we were able to get higher limits, which were really offered at a lower price, if you will. And so, as we bring a lot of the teams in through here on an annual basis, now they're starting to ask for us. They want the supply chain team involved in the process. They want to hear about what we're doing, what we've been doing, and what we're going to be doing in the future. And I think that any supply chain expert that wants to get a good insurance program in place, it would be beneficial to them and to their company to be involved and to educate them as part of the process.
Very good. Well, you certainly got me, interested in this, and I think we're going to do a lot more work on Supply Chain Digest on this because I come to it more directly, just or specifically on the operations side. So very good. So Brian, that's a good segue to you. You're obviously coming at it from the finance treasury side of things. What's your perspective on how your side of the table can best work with, collaborate with the supply chain side?
Really the collaboration with the supply chain team is key. Like Bonnie said, they're the ones that really know the supply chain the best, and it's not the treasury team or the insurance companies. As I tried to point out in the video cast, that collaboration has been key in our insurance buying activity where we're working closely with the supply chain team. One of the things we've been able to do with our internal organization is to share with them the analyses that we do when we're looking at buying insurance, deciding how much to buy, and trying to understand our risk profile. So, for example, one of the analyses that we do is to look at all of our Tier 1 suppliers and how they're exposed to catastrophic risks like earthquake, hurricane, and flood. And by sharing that information with our own supply chain group and the real supply chain risk managers in the company, it's helped us to focus help the supply chain group to focus some of the work they've done, including with Resiliency. And of course, they're focused on all sorts of risks, not just natural catastrophe risks. But as we all know, the natural catastrophes have caused the biggest interruptions within the industry.
Yeah. It seems to me, Brian or Bonnie or anybody, that we have lots of trade-off curves in supply chain. So inventory versus transportation, et cetera. But just as I'm hearing this, it seems to me there's got to be a level of trade-off here, because I could spend some money to mitigate risk on the supply chain side that might reduce my need or obviate my need potentially even for insurance on the insurance side, or I may do less mitigation on the supply chain side and hence need a little more protection on the insurance side. And so which is the better deal? I guess I'd kind of put it the way I mean. Do I have that at least partially right?
I'll take that one. This is Brian again, just real quickly. I mean, that's been one of the advantages of all the work that we've done, including with Resiliency, is just, through that deeper and better understanding, then you can make better decisions, whether they're hedging decisions, with insurance or whatever other areas it may affect. But you learn more, and then you can decide, okay, do we need this much insurance? Do we need more? And it's been illuminating in that way.
Yeah, Dan, I think you raise a good point here, and Brian's reiterated on it. It emphasizes the need to, as someone in the risk space or in the operations space who has access to some of these solutions, whether it's insurance, inventory management, or other solutions such as programs, continuity programs, that you look at it in the light of a portfolio, just the way you would look at an investment portfolio, and to have access to those tools and that competency, so that when the business managers are making the decisions and they're looking for some offset, when they look at performance, and they see that they're taking on too much risk, to be able to have those vehicles ready for them to assess as a vehicle to offset the amount of risk. And I also think that leads to kind of a tipping point, because having worked with a number of organizations, you get to the point where you have this conversation a few times and you realize that you have some intelligence that not only takes a defensive position, but also could potentially put you on the offense. And, as you mentioned, I'm working on this new book, and I'm sorry for the plug there, but, the uncertainty advantage is really about that. It's over the years, it's evolved to a point as the programs start to mature, that there is some advantage that could potentially be used as a market differentiator as you become more familiar not only with your own competencies and capabilities, but the lack of competencies and capabilities of your competitors or others in the industry, so that when there are anomalies, you can take advantage of those anomalies and capitalize on the opportunity. And that's what the uncertainty advantage is all about. Sorry for the plug.
Yeah, and that's perfect, Gary, because as coming into this as a solution provider, then what we're seeing, and I'm sure Vani will corroborate this, but within the supply chain organization, information really exists in silos. So if you look at a commodity management organization, which has expertise in working with suppliers and having domain knowledge expertise about whether you're working with a memory supplier or an ASIC supplier or a disk drive supplier, you really understand your supply chain for your category or commodity group. What is very powerful when you put all of the supply chain intelligence into a central repository, and now you can see, well, what does my disk drive supplier have in common with my sheet metal supplier in the second tier supply chain, or do they both, do all of my suppliers all buy some critical material from a second tier supplier that could become a massive failure point for me? And as Gary very, very nicely put it, you can use it defensively, but you can also use it offensively to now, create an option to, book that capacity or buy up available capacity. Apple actually spent billions of dollars a few years ago with displays. Their displays where they found that was a critical dependency that could really help if they captured the display market, then they could keep competition out, and they did that, and they kept competition out for multiple years while they were happily building up a massive market share in the tablet market.
Yeah. Very good. Okay, so we've had a great conversation. I think we'll round it off with just one more question. Bunny, I'm going to come back to you. I think you've got, it's all kind of all tying together here, really, the way this conversation and the Q&A has gone. But I think you've got an example how your overall approach there at Palo Alto, in combination with using some of the tools from Resiliency, has paid off for you in terms of some specific risks that we saw a few years ago.
Yeah, so we've definitely had a few situations. I mean, all of us probably were impacted specifically with the Thailand floods, for example. And with that being a few years ago, early insight for us into what would become a worldwide hard drive shortage enabled us to have first mover advantage to purchasing hard drives that continued obviously providing uninterrupted equipment delivery to our customers and avoiding any additional interruption in product sales and potential insurance carrier payout. That came for us at a time that was extremely significant in our company, with us experiencing the hypergrowth that we were experiencing, to not impact our customers, to not have to put in an insurance claim, and more importantly, that the information came to us so quickly through a tool like Resiliency that we had teams that were literally able to react to that within hours and a day versus several days for a lot of other companies that were trying to really figure out what was going on within their organization.
Okay, great story. I can't believe I'm saying this, but I could go on for a while talking about insurance. I think with that, we're going to wrap it up. It's been a great broadcast, a great QA here. Again, look for email from us in the next 24 to 48 hours. They'll have an on-demand version of the broadcast, a recording of this Q&A, some other goodies as well, some of the resources that Bindia pointed out in the course of the broadcast, et cetera. We'll link to all of those. I know you want to take advantage of it. I want to thank our panel again, Bindia, Gary, Vani, Brian, for joining us today. It's been a fantastic discussion. Appreciate their appreciation. We look forward to seeing you on another broadcast on Supply Chain Digest and the Supply Chain Television channel very soon. Thanks so much, everybody. Have a great day.